Jeff Bezos wants to eliminate income taxes for half of America. What it really means for your wallet. What if your next paycheck suddenly got bigger? Not because you received a raise, not because you worked more hours, but because the government simply stopped taking federal income taxes from your paycheck. It sounds like a campaign promise, but this idea is now being discussed by one of the richest people on earth, Jeff Bezos, the founder of Amazon, the owner of Blue Origin, a man worth hundreds of billions of dollars. Recently, Bezos made headlines when he proposed eliminating federal income taxes for the bottom half of American earners. His argument was simple. Millions of Americans are struggling, and instead of giving them complicated programs, tax credits, or temporary relief checks, why not simply let them keep more of the money they already earn? At first glance, it sounds incredibly appealing. Who doesn't want lower taxes? But as with most economic ideas, the real story is more complicated. Who would actually benefit? Would it help poor households? Would the middle class finally get a break? And perhaps the biggest question of all, who pays the bill? Today, we're breaking down Jeff Bezos' proposal, the numbers behind it, and what it could mean for the future of American taxpayers. Let's begin. When people think about billionaires and taxes, they usually imagine billionaires fighting against paying more. That's why Bezos' comments surprised many observers. During a CNBC interview, Bezos said something that immediately grabbed attention. He argued that federal income taxes should be completely eliminated for the bottom half of American earners. Not reduced, not lowered, eliminated. His reasoning was straightforward. He believes Americans who are struggling financially need a better opportunity to improve their lives. And one way to create that opportunity is to allow them to keep more of their income. According to recent tax data, the bottom half of taxpayers earn less than approximately $54,000 annually. There are roughly 76 million tax-paying households in this category. On average, these households pay about $900 per year in federal income taxes. For many families, $900 is meaningful money. It could cover groceries, utility bills, car repairs, or help build an emergency fund. To Bezos, eliminating that burden could provide immediate relief. But the proposal raises an important question. If millions of people stop paying taxes, what happens to the money the government loses? We'll come back to that shortly. First, let's understand who would actually benefit. Who really pays federal income tax? Many people assume everyone pays federal income tax. The reality is very different. The U.S. tax system contains dozens of deductions, exemptions, and tax credits. These credits often reduce a family's tax bill dramatically. In some cases, all the way to zero, that according to the Tax Policy Center, roughly 40% of American households pay no federal income tax. Let that sink in. Nearly 4 out of every 10 households already owe nothing in federal income taxes. This means that many lower-income families would receive little or no benefit from Bezos' proposal because they already have no federal income tax liability. That's one of the most important facts, often missing from headlines. The biggest beneficiaries wouldn't necessarily be the poorest Americans. Instead, many economists say the largest gains would go to middle-income households. Families earning enough income to currently pay taxes, but not enough to be considered wealthy. This distinction is critical because when people hear tax cuts for the poor, they often imagine dramatic financial changes. But many of the poorest households already receive tax relief through existing programs. The real impact may land squarely in the middle class. Interestingly, Bezos isn't the only person discussing this concept. Several lawmakers have proposed similar plans. One notable example comes from Representatives Don Beyer and Chris Van Hollen. Their proposal is known as the Working Americans Tax Cut Act. The plan would eliminate federal income taxes for many lower-income households, single taxpayers earning less than $46,000. But the proposal doesn't stop there. It also provides tax discounts for middle-income earners. In other words, it creates a gradual transition instead of a sharp cutoff. Economists analyzing the proposal found something interesting. The largest tax savings would occur among households earning roughly $53,000 to $92,000 annually. These families could save an average of about $1,300 each year. That may not sound life-changing, but for many families, $1,300 represents a mortgage payment, several months of groceries, a vacation, a contribution to retirement savings, or the beginning of an emergency fund. For households living paycheck to paycheck, every dollar matters. This is where economics becomes difficult. Everyone loves tax cuts. Few people enjoy discussing how to pay for them. Government programs cost money. Roads, defense, Social Security, Medicare, veterans benefits, education programs, infrastructure. The federal government relies heavily on tax revenue. If you remove taxes for tens of millions of households, government revenue declines significantly. Analysts estimate the Working Americans Tax Cut Act could reduce federal revenue by nearly $1.6 trillion over 10 years. That's a massive number. To put it in perspective, that's more money than the annual GDP of many countries. Whenever politicians propose tax cuts, they generally have three choices. Option 1. Reduce government spending. Option 2. Increase government borrowing. Option 3. Raise taxes somewhere else. Each option creates winners and losers. And that's where the political battle begins. Many supporters of these proposals suggest a simple solution. Raise taxes on wealthy individuals. The argument sounds reasonable. If lower-income families pay less, perhaps billionaires and millionaires should pay more. Supporters point out that some wealthy individuals pay surprisingly low effective tax rates because of deductions, investment structures, and tax planning strategies. Critics argue that the system allows the wealthy to legally reduce their tax burden. Meanwhile, average workers have fewer opportunities to do the same. The Yale Budget Lab estimates that raising taxes on high-income households could offset much of the lost revenue. However, opponents argue that higher taxes on investment and entrepreneurship could reduce economic growth. This is one of the oldest debates in economics. How much should the wealthy contribute? There is no universal agreement, and economists continue debating the answer today. When Bezos was asked whether he would personally support paying more taxes to fund his proposal, his answer surprised many people. He didn't directly say yes. Instead, he shifted the discussion. According to Bezos, America does not have a revenue problem. America has a spending problem. In other words, he believes government spending, not tax collection, is the core issue. This view is shared by many fiscal conservatives. They argue that government spending has grown too rapidly, and that simply collecting more taxes will not solve underlying problems. Others disagree. They argue that rising healthcare costs, aging populations, and growing national obligations require more revenue. Again, reasonable people disagree. But Bezos' comments reveal an important reality. Even when people agree on helping struggling families, they often disagree on how to pay for it. As investors, it's easy to get caught up in political arguments. But let's focus on what matters financially. Tax policy affects three things: your income, your spending, and your investments. If taxes decline, households generally have more disposable income. More money may flow into savings accounts, retirement plans, brokerage accounts, or consumer spending that can stimulate economic activity. But if tax cuts significantly increase government deficits, borrowing may rise. Higher borrowing can influence interest rates, inflation expectations, and long-term economic growth. This is why investors should pay attention to tax policy, not because of politics, but because policy eventually affects markets. The goal isn't to choose sides. The goal is to understand the potential consequences. There's another lesson hidden inside this debate. Most people focus on how much they earn. Successful investors focus on how much they keep. A person earning $50,000 who keeps more of their income may build wealth faster than someone earning $70,000 who constantly spends everything. Whether taxes rise or fall, the fundamental principles remain unchanged. Spend less than you earn. Build an emergency fund. Invest consistently. Avoid unnecessary debt. And think long-term. No tax proposal will create financial freedom by itself, but smart financial habits can. Jeff Bezos' proposal has sparked a national conversation. Supporters see it as a way to help struggling households keep more of their earnings. Critics question how the government would replace the lost revenue. Economists point out that the biggest benefits may actually go to middle-income families rather than the poorest households. And politicians continue debating whether tax cuts should be funded through spending reductions, higher taxes on the wealthy, or additional government borrowing. Regardless of where you stand politically, one thing is clear. Taxes matter. They influence household budgets, business decisions, investment returns, and economic growth. As investors, our job is not to react emotionally. Our job is to understand the incentives, follow the numbers, and make informed decisions. Because wealth is not built by headlines. It is built by knowledge. If you enjoyed this video, subscribe to the Illiterate Investor. Because financial freedom doesn't come from luck. It comes from understanding how money really works.